If I had to start investing from zero today, I would not start by picking individual stocks, and I definitely wouldn't start by asking, what's the next stock that's going to explode? I'll do five things in this exact order. So, if you have $100, $500, or $1,000 and you're ready to start investing, but you have no idea what to actually do with it, this video is for you. I'm going to show you what type of account I'd consider, how I'd research what to buy, how much I would start with, and how I'd automate the process. And stay with me because I'll show you exactly how I would think about investing my first $500 if I was starting over today. Let's get into it. Hi, I'm Dr. Lena, a tech executive, a business and technology professor, and a real estate investor. And on this channel, I teach working class professionals how to turn their income into assets and build long-term wealth. If you watched my last video, you already know the framework that I teach: income, asset, cash flow, freedom. Today, we are focusing on one part of the equation. How do you actually start investing in the stock market? Let's start with it. Step number one, understand what you're actually buying. This is key. When people hear stock market, they sometimes imagine someone sitting in the front of 6 computer screen buying and selling stock all day. That's trading. That's not what we're talking about today. We are talking about long-term investing. When you buy a stock, you're buying a small ownership interest in a company. But here's the problem for a beginner. How do you know which company is going to win? Maybe Apple, Microsoft, Amazon, Nvidia, or a company that you've never heard of that somebody on social media says is about to explode. Today, trying to answer that question is where many beginners get into trouble. And I learned that lesson the expensive way. Earlier in my investing journey, I lost close to $100,000 in the stock market, specifically $99,000. Not because long-term investing doesn't work. I was chasing opportunities without fully understanding what I owned and risk I was taking. And that experience completely changed the way I invest. Today, I don't believe a beginner needs to start by trying to identify the next winning stock. There is a much simpler way to think about investing. Instead of buying a company, you can invest in a basket of companies. What do I mean? That's where ETFs and index funds comes in. An ETF, that's an exchange traded fund. You can hold many different investments inside one fund. Think about it like a basket. Instead of depending on one company, depending on the ETF, your investment could give you exposure to dozens, hundreds, or even thousands of companies. For example, an ETF that tracks the S&P 500, Standard & Poor's 500, gives you an exposure to hundreds of large US companies through one investment. That doesn't mean there is no risk. Investments can go down. You can lose money, and past performances does not guarantee future results. But diversification can help reduce your dependence on your performance of one individual company. So that's step number one. Understand what you're actually buying. Step number two, choose the account where you are going to hold your investment. That's very key. And this is where beginner gets confused all the time. Your investment account and your investment are not the same thing. Okay? Think about the account as a house. The investments are what you put inside the house. Okay? You might have a 401k, a Roth IRA, a traditional IRA, a regular taxable brokerage account. Those are different types of account. Inside those accounts, you can hold investment in it. That could include stocks, ETF, mutual funds, bonds, or other investment depending on the account and provider. So remember this, the account is the container, the investment is what inside the container. Once you understand that distinction, investing starts making a lot more sense to you. So which account should you use? That depends on the purpose of your money, your eligibility, your tax situation, and when you start to need the money. If your employer offers a 401k match or something called pension and you are eligible, understand the benefit first. If you are eligible for an IRA, that may also play a role in your retirement strategy. And a taxable brokerage account can be useful for investing outside of the retirement account. I'm not going to tell you that one account is automatically better for everybody because it isn't. Instead, before you open an account, ask yourself, what is this money for? When do I need this money? What are the tax rules? What are the withdrawal rules? And does this account actually fit my goals? That's step number 2. Now, let's go to step number 3. Decide what you are actually going to invest in. This is where a lot of people, especially beginners, freeze. They open the account, transfer the money, and then stare at the screen thinking, okay, now what? Because suddenly there are thousands of investment choices. Here's the question I want to ask you. Do I actually understand what I'm buying? Do you? For many beginners, broad, diversified, low-cost index funds or ETF can be a place to begin researching. And you're going to hear ticker symbols everywhere: VOO, VTI, QQQ, SCHD. Maybe you've already heard some of this. But please, don't buy an investment simply because you've heard the ticker 50 times on social media. Those funds don't all do the same thing. They can have different objectives, holding, concentration, strategies, fees, and even risk. So look underneath the ticker. What does the fund actually own? Easy. What index fund does it track? How diversified is it? What does it cost? How much overlap might it have with other investments you already own? And most importantly, why are you buying it? If you cannot explain in 1 or 2 simple sentences what you own, why you own it, that's a sign you need to do more research before putting in your money. You also don't need 10 or 15 ETF just because you've heard 10 or 15 ticker symbols. More funds do not automatically mean more diversification. Sometimes you are buying many of the same companies again and again through different funds. Keep it understandable. Step number 4, decide how much you're going to invest. One of the biggest misconceptions about investing is that you need thousands and thousands and hundreds of thousands of dollars before it's worth starting. You don't necessarily need that. Even with $1, you can start. Depending on your brokerage and the investment, fractional shares may allow you to start with much smaller amounts, as little as $1 a time. So instead of asking, do I have enough money to become an investor? Ask, what amount can I invest consistently without jeopardizing my bills, emergency savings, or other financial priorities? Maybe that's $50 for some. It could be $100 for others, $500, $1,000 maybe. Your starting point is less important than building a sustainable system. I'd rather see someone invest $100 consistently for years than invest $5,000 once, panic the first time the market drops, and then never invest again. Consistency matters. I say this again and again. Consistency is key. And if you're listening to this thinking, finally, someone is explaining investing in a way I can actually understand, subscribe to Money Talk with Dr. Lina. I break down investing, real estate, income and wealth building for working professionals without making money more complicated than it needs to be. Step number 5, automated. This is key. This is one of the simplest ways to remove emotions from your investing process. Choose an amount, choose a schedule, and where appropriate and available, automate your contributions and investment. Maybe you invest every payday, maybe once a month. The important part is that you are not just sitting around every week asking, is today the perfect day to invest? Because nobody consistently knows the perfect day except God. The market will go up, the market will go down. There will be elections, interest rate decision, recession, great economic report, terrible economic reports, and there will always be another headline telling you why this week is either the greatest or the worst time in history to invest. If you are building wealth over decades, you need a strategy that can survive headlines, not one that changes every time you open your phone. Now, let me show you how I would think about my first 500, because I promised you I'll do that, right? We're going to do that. If I was starting from zero with a $500, that the first thing I would not do is ask, which 5 stocks should I buy? First, I'll make sure this wasn't money I needed for next month's rent and upcoming bills, my emergency funds, or expensive high interest there, because money you are likely to need soon generally should not be exposed to the stock market volatility. Assuming my financial foundation was already in place, I'll decide which type of account fits the purpose of the money. Is this retirement account? Is this long-term money outside of retirement? What account makes sense based on my goal and eligibility? Then I'll research a diversified investment that I understand that fits my long-term strategy. But here's the most important part. After investing that first $500, I wouldn't sit back and say, oh, great, I'm now an investor, right? No, I'd ask, how do I make the next $500 happen? Because your first $500 probably isn't going to make you wealthy. Its real job is to help build a system that could eventually make you wealthy. One contribution is an event. Consistent contributions becomes an habit, and a habit repeated over years can become a portfolio. If $500 isn't realistic for you, that's okay. Maybe your number is $100. Maybe it's $50. The point isn't to impress anyone with how much you're investing. The point is to build a system you can actually sustain. Now, before you start, there are 5 beginner mistakes I want you to avoid. First, don't invest money you expect to need soon. Okay? The stock market can fall, sometimes significantly. You don't want to be forced to sell investment because you suddenly need money for an immediate expense. Second, don't chase what is trending. A stock or investment being all over the social media doesn't automatically make it a good investment for you. Research first. Third, don't confuse a low share price with something being cheap. A $10 stock isn't automatically a better deal than a $200 stock simply because the share price is low. Fourth, don't panic every time the market falls. Volatility is part of investing. If you are investing for the long term, your strategy should account for market declines before they even happen, not after. And the fifth, don't wait until you understand absolutely everything. You should understand what you're buying, why you're buying it, the cost involved, and the risk you're taking. But you don't need to know everything about the stock market before you can begin learning how to invest responsibly. So let's put the entire process together. Step 1, understand what you're buying. Step 2, choose the type of account that fits your goal and situation. Step 3, research diversified investment you actually understand. Step 4, choose an amount you can consistently invest. And step 5, automate the process where appropriate. Then give it time. Time in the market always wins time in the market. Investing can become more sophisticated as your knowledge and your portfolio grows, but complicated does not automatically mean better. Your goal isn't to build the perfect portfolio. Your first goal is to become an informed, consistent investor. But here's what I want you to understand before you go. Investing is only one part of building wealth, because you can choose great investment and still sabotage your financial future with bad money decisions. You can invest and still overspend. You can raise and allow lifestyle inflation to consume every additional dollar. You can build assets and then take on liabilities that keep you financially stressed. And you can make more money every year without actually becoming wealthier. That's why there are 5 money rules I believe every working professional should understand. Rules about how you spend your money, how you save, how you invest, how you handle increases in income, and ultimately how you make your money work harder for you. And that's exactly what we are covering in the next video. 5 money rules that will change your life. Watch the next one. And if you are a working professional who wants to turn your income into asset and build real long-term wealth, subscribe to Money Talk with Dr. Lena, because that's exactly what we do here. Remember, income pays bills, asset builds freedom. I'll see you in the next video.